In this video, we'll be diving into the math behind whether it's better to pay off your mortgage early or invest. If you're asking this question, it likely means you have extra money after paying your bills each month. Congratulations! This is a situation many people never reach, as the personal savings rate in America hovers around 3.6%, and many live paycheck to paycheck. To determine whether you should pay off your mortgage or invest, several factors come into play, but the biggest one is your mortgage interest rate. We'll first explore how mortgage payments are structured because understanding this is key. Then, we'll break down what makes the most sense mathematically and financially. Lastly, we'll share some strategies to help pay off your mortgage early if that's your goal, along with other intangible factors to consider when making this decision. How mortgages actually work. When you take out a mortgage, you're borrowing money from a bank to buy a home. Over time, you repay this sum with interest, which is how banks make their profit. Let's say you borrow $400,000 with a 30-year fixed-rate mortgage. The bank calculates your monthly payments over 30 years, or 360 payments in total. Each mortgage payment consists of two main components. 1. Principal, the amount of money you borrowed that needs to be repaid. 2. Interest, the cost of borrowing the money, calculated on the remaining balance. For example, on a $400,000 loan with a 7% interest rate, your monthly payment might be around $2,660. However, in the first month, a large portion of this payment, $2,233, goes toward interest, and only $327 goes toward the principal. This uneven distribution continues for many years. Mortgages follow an amortization schedule, where interest payments are front-loaded, meaning you don't make significant progress on the principal for a long time. In fact, during the first 20 years of a 30-year mortgage, most of your payments go toward interest, not the principal. For example, after 20 years of payments, you'd still owe $229,200 on your $400,000 mortgage, even though 2/3 of the time has passed. In many cases, by the time a mortgage is fully paid off, the amount of interest paid equals or exceeds the original loan amount. For a $400,000 loan at 7%, you'd pay $558,500 in interest, bringing the total cost of the mortgage to $958,500. Understanding this structure shows that paying down your principal faster can save you a significant amount in interest over time. Stock market returns versus mortgage. Interest rates. Now that we understand how mortgages work, let's look at stock market returns. Historically, the S&P 500 has averaged a 10.26% annual return since 1957. After taxes, you can reasonably expect a 7 to 8% return from investing in the stock market. If your mortgage interest rate is low, say around 3%, the math suggests that investing your extra money instead of paying off your mortgage could provide a higher return. For example, if you have a 3% mortgage, making extra payments on it would essentially earn you a 3% return on that money. However, investing in the stock market could yield a 7 to 8% return, which is higher than your mortgage rate, making investing the more lucrative option. But when interest rates are higher, like 6 to 7%, the decision becomes less clear. Paying down a mortgage with a 6% interest rate effectively gives you a 6% risk-free return, which can be harder to achieve in the stock market due to market volatility and the risk of losses in certain years. For example, in 2018 and 2022, the S&P 500 posted negative returns. The general rule is that if your mortgage interest rate is below 5%, it's better to invest. However, if your mortgage rate is 6% or higher, paying off the mortgage might make more sense, especially if you prefer the peace of mind that comes with eliminating debt. Time horizon, mortgage versus investment. Another key factor to consider is your time horizon. The more time you have left on your mortgage or until retirement, the greater the potential benefit of investing. For instance, if you have 25 years left on your mortgage and invest an extra $500 a month, earning an 8% return, you could end up with over $473,000. On the other hand, paying that extra $500 toward your mortgage would save you $148,000 in interest over the same period. The difference lies in how mortgages and investments work. Mortgage payments reduce the principal and save you interest, while investments compound over time, growing exponentially. The longer your time horizon, the more beneficial it is to invest rather than pay off your mortgage early. When paying off a mortgage makes sense. While the math may favor investing in many cases, there are intangible benefits to paying off a mortgage. These include 1. Peace of mind. Owning your home outright can provide a sense of security and reduce financial stress. 2. Increased cash flow. Without a monthly mortgage payment, you free up that money for other financial goals or lifestyle changes. 3. Lower debt-to-income ratio. Paying off your mortgage can improve your credit score and make it easier to qualify for other loans if needed. 4. Retirement readiness. Having a paid-off home in retirement means fewer expenses, allowing your retirement savings to stretch further. Tips for paying off your mortgage. Early. If you decide that paying off your mortgage early is the best choice, here are 3 strategies to do so without stretching your budget too thin. 1. Bi-weekly payments. Instead of making monthly payments, split your mortgage payment in half and pay it every 2 weeks. This results in 26 half payments, or 13 full payments, per year, effectively making 1 extra payment annually. Over time, this can shave years off your mortgage and save you thousands in interest. 2. Extra monthly payments. Even paying an additional $100 or $200 each month toward your principal can make a significant difference. For example, on a $400,000 mortgage with a 7% interest rate, an extra $200 per month could save you 6 years of payments and $126,000 in interest. 3. Windfall payments. If you receive a tax refund, bonus, or inheritance, consider applying that lump sum toward your mortgage. A one-time payment of $12,500 on a $400,000 mortgage could reduce the loan term by 2 years and save you $78,900 in interest. Remember, if you choose to make extra payments, ensure the money is applied to the principal and not future interest payments. This is key to reducing the overall interest you'll pay. Thanks for watching. Whether you choose to pay off your mortgage early or invest, the right decision depends on your unique financial situation, mortgage rate, and goals. By understanding the math behind each option, you can make a choice that works best for you. Let us know in the comments which path you plan to take. We'd love to hear your thoughts. Don't forget to like, subscribe, and check out our other videos for more tips on managing your money and building wealth. See you in the next video.